So here we are.
Here we are again. Bench talk.
We're going to we're going to talk about all the things that affect people that are trying to buy houses.
All the things that is affecting this crazy industry right now. Yeah. Talking about real estate and finances.
Yeah.
Some good stuff.
Yeah.
And some bad stuff.
Yeah. And so hopefully if you are in the market, you think you might want to buy a house this year, we can provide you with some insight that might help you a little bit with that process.
Hopefully so. So I'll say, what are the challenges you are seeing right now with people being approved for a mortgage?
Affordability. House prices being a little bit higher. The interest rates are a little bit higher than they have been in the past. So just trying to find areas that you can afford on your salary, because wages haven't really kept pace with everything else. So that's been probably the biggest thing.
I think for me, the people who have kind of come to the conclusion that I'm going to make that jump into home ownership, they are finding that, yes, it is less affordable for them. Just say, for instance, like single people. If you're divorced and you are applying off of one income, what does that look like? It's kind of like you can't have any other bills.
Yeah, that's true.
Because the average cost of a house is right now, the average person don't make enough. They just don't.
So you're licensed in Tennessee and Mississippi.
I am licensed.
So have you seen any differences in affordability between the two places?
So I have seen some difference in the affordability, but you, of course, know you have to take, you also have to take into context the taxes and the insurance. And it makes a difference where you live. Yeah. That plays a big part. So, you may be able to afford the mortgage by itself.
Right.
But once taxes and insurance is added to it, it could be a little bit different. It's kind of like city versus county versus state.
Yes.
I mean, so...
And that's a big difference.
It's a big difference. So
the difference between city and county taxes added into the payment versus county only. We worked up a payment earlier, you and I did earlier, for a lady that was buying in Tennessee in Shelby County, and it was county only, and it saved her like $200 a month on just that little
alone
difference.
So
that's a good point.
It's a good point. So I guess one of the things too is talking with you as a lender. Sometimes it doesn't sound good coming from me, the real estate person, because I'm supposed to talk all things home. So I like for my lender to be able to tell the people about why should you not purchase a car this year if you're going to try and buy a house later this year. So why is that not a good idea?
So when we are calculating out how much you can be approved for on a mortgage, we do some calculations, and the first calculation we do is what they call debt to income ratio. So we just take the income and we multiply it by a certain percentage that's allowed by the particular loan program that they're looking at, and then we'll subtract their debts from it. What's left over is how much house payment they can be approved for. So if you have a $400 car payment, then that's going to reduce the amount of the payment that you can qualify for, because we have to count that $400 off of that. So
that's a used car right now.
Yeah,
in today's market, that's a used car. That's not a new car.
Right. More closer to $700-800 sometimes, and that can seriously reduce the amount that you can be approved for. So if you can wait, if you can make that car keep going for a little bit longer, it would be in your best interest, because a house is going to appreciate and eventually make you money, and a car is always going to depreciate the minute that you drive it off the lot. Yeah.
I like for you to explain that, just because That's your world.
Mm-hmm.
I just live in it. So I like for her to explain that, because I don't ever want a customer or a client to think that I am trying to give them financial advice. Even though I'm trying to advise them, not give actually advice, but kind of advise them of what I see that works better.
Right.
But also, another thing is that, when people look at what they want versus what they can actually afford, sometimes there's, what I want is up here, but what I can afford is really way down here. So trying to find a common ground in that, because a starter home used to be, you could get a home for $160, and it was a nice, very nice house. And now that doesn't exist anymore.
Right.
So for just say a 25-year-old out of college wanting to buy a house, but have student loan debt, tell them what we talked about before about having those student loan payments in deferment, how it counts towards.
And it depends on the loan program that you're doing. Each program has its own guidelines and qualifications as far as that's concerned. But let's just take FHA for an example. FHA requires that even if you're not in repayment on your student loans, we have to count 0.5% of the balance in that debt to income ratio that we talked about just a minute ago. If you owe $20,000, then you can do that math and determine, okay, well, we still have to count that even though that's not in repayment yet. On conventional loans, there is a way around that if those payments are included in an income-based repayment program, and we can get the documentation on that, then that might be an option that we can do. If you've got a lot of student loan debt that's affecting your affordability, then maybe conventional options are going to be better for you.
Okay. So I guess even if they're in deferment, maybe they need to be making consistent monthly payments.
I would.
Okay.
I would, because you're going to have to count that anyway, and you may as well be whittling down that balance, because then that reduces the amount that we have to count your payments.
Okay. Good deal. So it's tax season here.
Yes.
People are now filing taxes.
Yes.
And I always like to hear how, if, just say that person, they have the credit score, they have the income to purchase, but they don't have, just say, a lot of money in savings for down payment and closing costs, but they're expecting to get something back on taxes. As a lot of single people sometimes do. If they have dependents, they sometimes get back money in income tax. Tell them how they could use maybe income taxes or 401k.
That's when you want to get creative. There are a lot of different ways. You can get a gift if you've got a family member that's willing to provide you a gift to help with the down payment. In the market, if the seller might be willing to help contribute toward closing costs, and that reduces the amount of money that you need. If you have a 401k, you can usually talk to your 401k administrator about doing a loan against that 401k or even a withdrawal to help with that. Tax money, some people get $5,000 in tax money. That's a pretty good chunk that you can use to buy a house, and that would be a really good use of that money as well, rather than blowing it on whatever whatever.
Right.
So,
whatever.
And then there are all kinds of down payment assistance programs that are available, and depending on where you're buying, you can talk to your lender about it. I know that we have several different programs. We were talking about that earlier.
What's your favorite? What is your favorite down payment program right now, if you have one of your favorites?
Right now, and I've just learned about this one, and it's called
She's giddy about this one.
I'm Ready First. It's a good program. If you currently live in a particular area, particular areas, it doesn't matter where you're buying. as long as you currently live in some of these areas, then you can get up to $6,000 in grant that you can apply toward that down payment. It is a 97% conventional loan, so you only have to put 3% down to begin with, and then you'll get that up to that $6,000 grant right on top of that. The other really cool thing about that program is usually on a conventional loan, unless you're putting a big chunk down, what the seller can contribute to your closing cost is going to be limited to about 3%. Not on this program. They can go up to 5%.
Okay.
So that means, that could very well mean that the seller could cover all your closing costs if they'd be willing to, and if you offer the right amount, and your offer is the one that wins, then you get the $6,000 in grant money that you can use toward the down payment. And then the other cool thing about this one is you don't have a minimum amount that you have to have from your own funds. So you could get a gift from a family member. There's no minimum amount that you have to contribute. Wow. So it's a really good program, and it really bridges the gap of homeownership for a lot of people. And that's why I'm so excited about it right now.
I know she's really, really excited about that program. But I do, one of the things, about that gift, one of the things, because I know I had to be very strategic in talking to you when we were going through, a gift with somebody. You have to really make sure, from the real estate perspective, you have to really make sure that the lender provides the information to the client on how to accept that gift, because that gift has to be accepted a certain way.
Yes.
For the underwriters.
Yes.
So we want to make sure that, if you're using another lender that's not Shelley, just make sure that you always tell your client to speak with the lender about how they're going to receive that gift before they receive it, because it has to be done a certain way.
That's right.
In order for it to work.
And that's really with anything. When you get a pre-approval, the documentation that you have to provide is very specific. But then once you get that pre-approval, ideally nothing changes. But if you have a situation that comes up, you can talk to your lender about it. Like, I'm about to have a settlement come in, and how do I need to document this? Or my dad said that he was going to give me a gift, so he's got cash. Is that fine? And so you really, the best thing that I can tell you to do is just talk to your lender and tell them that they're kind of like your attorneys, right? So you tell them everything and let them tell you how it needs to be handled. How it needs to be done.
Because I am sure that you've probably heard more stories. So nothing surprises you. And I always say no question is a dumb question. That's except the question you choose not to ask.
That's right.
Because you don't ever want your deal to fall through because you didn't ask the right questions.
That's right.
Or you did something without asking. So just, I just always
And there's no reason to be embarrassed, because this is always a judgment-free zone in every way. So I'm not sitting here in judgment of people. I'm here to help people buy houses. I'm not here to, that's the underwriter's job is to determine whether or not they qualify. That's not I'm not judging. I'm going to help you figure out what you need to do to reach your goal of homeownership. And so you can tell me anything, and I'll help you figure it out.
We're going to try to find a solution.
Yes.
By
Problem
any means
solvers.
necessary.
Problem solvers. Yeah, that's right.
Yeah, so I think that's about it for today. We're going to have these little bench conversations here. Going to be coming to you more often this year, 2025. Try to give you at least 15 minutes or so of information. Yeah. If you can just give us 15 minutes of your time, we will try our best to help get you in a home this year. If there are some topics that you want us to discuss, feel free to reach out to us. We will put our information We'll tag it in this video so you can reach out to us and ask us questions, and maybe on our next bench conversation we will discuss your topic. Okay, this is Latoya Newson-Harris with Coldwell Banker Collins Murray Realtors and
Shelley Dunn, Guild Mortgage.
we will see you all next time.
Yeah, thank you.